that if you had bought a home 20 years ago, 2004, and gold price was what it was, it took X amount of ounces of
Right.
gold to buy that house. Well, today it took like that gold, the house price went from 175 to average price today was something like in the 385, 390. Well, the gold went from that price today, the gold would be worth $1,250,000.
Mm.
So you say, well, what does that mean? That means that somewhere in the world, and I think all over the world, particularly now, people are saying, I don't trust that dollar. In fact, I don't trust a lot of sovereign currencies.
In a world of fluctuating markets and economic uncertainty, the role of gold as a reliable hedge against inflation has been a topic of ongoing discussion. TedOakley, the founder of Oxbow Advisors and a wealth management expert, has shed light on the precious metal's enduring appeal. Oakley highlights that people are naturally drawn to hard assets like gold because of their role as reliable hedges, especially during times of economic uncertainty. While some may consider alternatives like Bitcoin, Oakley stresses that gold's value has been proven as a stable trade mechanism over thousands of years. The appeal of gold as an alternative currency is particularly evident in countries facing economic instability or currency devaluation. Unlike paper currencies, gold is a tangible physical asset that retains its value even when traditional currencies fail. This makes it an attractive option for investors and individuals seeking to protect their wealth and purchasing power. Oakley's analysis reflects on gold's long-term performance, emphasizing that its value tends to rise over time despite periods of stagnation. This aligns with the broader trend in the gold and silver markets over the last 2 decades. While these metals remained relatively stable for centuries, they have experienced significant volatility since the late 20th century. For instance, between 2001 and 2011, gold surged by 528% and silver by 806%, despite inflation only rising by 25%. However, following their peak in 2011, both metals saw steep declines. Gold dropped by 40% and silver by 68% by 2016. Oakley also notes that while most of their investments generate cash flow, owning real gold, despite its lack of cash flow, is a valuable hedge. He believes that holding 4 to 5% of a portfolio in gold offers long-term protection, making it worthwhile despite the absence of immediate income. Before diving into this video, subscribe to our channel and hit the bell icon to stay updated with all our latest content.
Danny, for us, we own gold and gold or gold miners, in some cases both, in all three strategies. And I think people don't realize what gold is meant for, okay? It's meant to be a long-term hedge on something that will maintain its value. Just go back any period you want to use in gold. You'll see it over the long term, it goes up in price. Now, does it have periods where it doesn't go anywhere, like 2011 to 2016 or 17? Yeah, it does. That's what you have to live with. That's why you have to own a certain amount of it. But for us, we see it like this. I had a graph in our last newsletter, and one of the things I showed was, or the video actually, I showed that if you had bought a home 20 years ago, 2004, and gold price was what it was, it took X amount of ounces of
Right.
gold to buy that house. Well, today it took like that gold, the house price went from 175 to average price today was something like in the 385, 390. Well, the gold went from that price today, the gold would be worth $1,250,000.
Mm.
So you say, well, what does that mean? That means that somewhere in the world, and I think all over the world, particularly now, people are saying, I don't trust that dollar. In fact, I don't trust a lot of sovereign currencies, and I want it backed by gold. If you watch the oil trading now, you left the petrodollar, and people are starting, those countries, you look at those major countries, they're starting to say, hey, we'll sell you oil, but not for the dollar. You need to bring your gold. Well, I think the reason it does is because people want a hard asset that will hedge. Now, I know a lot of people think, well, I'll go the Bitcoin route, and maybe that works. I'm not saying it doesn't, but the main point is that if you look over time, and you can go back 4,000 or 5,000 years. This is not like in the last 2 decades. But gold has been it's a trade mechanism that people trade with, and it works. And I know the argument is it doesn't pay cash flow. But you don't have to necessarily have cash flow to make money. I know a lot of people have made a lot of money on raw land, And it doesn't pay cash flow, by the way.
Right.
But they made a lot of money on it. And so my argument to them is everything you own, we want cash flow almost everything we own, but the only thing we own that doesn't cash flow is real gold. Everything else we have cash flows. But we can afford to do that with, if you have 4 or 5% in gold and it's not cash flowing, but it's a hedge over time, I think you're okay. When Reagan came into office in 1980, 1980, gold went from basically 250, call it, to 850 in a short period of time, a couple of years. And then it sold off and it stayed down for a period of time. And then it has those periods. I think if you own gold, you just have to be willing to go with the periods when it's in a lull. And if you can't do that, you shouldn't own it, because there's going to be periods where over a 4 or 5 or 6 year period, you may not make any money on it. In fact, you may lose a little money on it. You have to have something in your portfolio that you can touch and hold and hold on to see. We think we're going into more of an inflationary, stagflation kind of era. And if we are, that means hard assets and commodities will do much better over this next 10-year period. And our portfolios are structured that way to a degree, especially one strategy. But, today, nobody believes that. But we sort of have a different approach. And most people think I want on 60% stock, 40 bonds. We're going to have in real short-term bonds. We're going to have 30% in value. 30% is going to be in really hard assets, real assets, 10% cash. And we're going to be willing to trade them.
I see.
If you buy bonds today, let's say you buy a bond more than 10 years, I think you have to be willing to trade it.
Oakley discusses the growing threat of currency debasement, suggesting that gold and silver could perform well in such a scenario. Despite the current skepticism, he anticipates that this debasement will occur, posing a significant challenge to traditional monetary systems. While gold and silver bullion are still commonly owned and traded, precious metals are no longer a primary form of currency and are not in wide circulation, especially daily. However, Oakley emphasizes that the risk of debasement remains relevant, even in modern economic times. The root cause of this debasement lies in the actions of governments, which can print excessive amounts of money, thus increasing the money supply without a corresponding increase in economic output. This imbalance leads to inflation, as more money is chasing the same amount of goods and services. Oakley's insights highlight gold and silver's lasting appeal as protective assets. While no longer used in daily transactions, these metals remain reliable stores of value and effective hedges against currency devaluation. Let's get back to the video.
Well, I think both of them are good in a period where you're going to have a debasing of the currency, which I suspect is going to happen. I know people don't think that right now, but if you look at where we are on a government debt level, and let's say we do this financial repression, which I'm talking about, which is you keep the short rates lower than the rate of inflation. That's how we got out of the debt to GDP stuff after World War II. Basically spent the next 15, 18 years with the rates a little bit higher, a little bit lower than the rate of inflation. So what happens is you don't realize it, but your dollar, that's debasing your currency in its own way, because it looks like looks like you're making 4% a year, yeah, okay, or 3%, but you don't realize it. But inflation's 5%. And so you might have more dollars later on, but they're not worth as much money. And to me, that's where all these metals will really pick up and go. Is when people start to notice that, much like it was, to a degree in the 70s, late 70s, that sort of thing. That's when you'll see it. It's not there right now because people don't realize right now they're getting blown up, and the dollar it's broken, but not as much as I think it will eventually. Yeah. Well, it would eventually hurt the dollar. And I know there's been talk of this for a decade, and they just never gotten there and been able to put together, alternative currency. Right now, it's still the same. I mean, the reserve currency, if you look at, reserve trading, it's still, I don't know, 2/3 of the trade, the dollar is. And they haven't gotten to that point yet. They're trying to get there. And a part of that is what I talked about in oil and gold, but they're just not there yet. But if they get to that point, then it won't be good for the dollar, because they'll be trading something else. And a lot of the things people don't realize this, I think, in the US, but so many of the commodities that you want to own, particularly specialty commodities, okay, we don't produce in this country. Somebody else produces it. And so if you look at it from that standpoint, we don't think very well long term on things like that. And when they get, if they ever get to that point, and I think they're trying to get to that point, but it could be a long time, but you have to get to the point where everybody agrees on, there's a lot more people have added to this BRICS group. It's not just the BRIC. I mean, now I think there's 16 or 17. So they're going to have a meeting in the mind, so to speak, to decide if they want to do that or how they would do it. But they want to do it. I'll put it that way. If they did it, to answer your question, it would be negative for the dollar, I think.
Yeah.
Well, they probably think that, and it looks like they've been doing this anyway, that they've always gone more toward hard assets. If you look at the direction they've gone. And a lot of those countries have gone, they want to go more and more toward hard assets. And I think in realizing that if you have one of the things we've forgotten about in the U.S. is that hard assets. For example, energy. You can't run manufacturing without energy. Well, we've put so many restrictions on all the energy, and you can't use it this way or that way or whatever. Why are you going to manufacture here? And you don't have the regulations on you, and then you've got China running circles around them. My point is that you have to have major energy to have major manufacturing. And I think a lot of those countries see that. They say, we're going a hard asset route. We're not going to do, we're not going to do just this intelligence kind of thing on IT type stuff and make all of our money on that. And I think that's where they're headed.
Gold and silver have long been trusted as value stores, especially during economic uncertainty and inflation. Though they are no longer used as primary currencies in everyday transactions, their historical role as reliable assets remains unchanged. As currencies lose value through debasement, gold and silver often become safe havens, protecting them from the erosion of purchasing power. What do you think about the role of gold and silver in today's economy? Let us know your thoughts in the comments below. If you found this video helpful, please like, subscribe, and hit the bell icon for more updates. Thanks for watching, and we'll see you in the following video.